Hello, this is Michael Bernstein, here for another tax and financial tip from Bernstein Financial. I'm here in the weight room. Today we'll just do what we're doing weights and I'll go out for a jog afterwards. Today the tax tip, the financial tip is a continued series of rental property. And in this particular episode, we're going to discuss the sale of rental property. I will do some curls and some air squats as we're moving along. Okay, so you have your rental property, you've had it for a while, now you want to sell it. So most likely you'll have a gain on the sale of rental property. If it's a loss, it'll be deductible. If you have a gain, it'll be taxable. If you have passive losses from before, as we spoke about in other episodes, you can offset those passive losses against the rental profit, the gain on the sale of the rental. And if the passive losses are enough to offset it fully, then there'll be no tax to pay. If there isn't, then there may be some tax to pay. The rate of tax you'll pay on the capital gain is anywhere from 0 up to around 24% federal, plus your state tax rate. In California, that's 9.3 at the highest rate. If you have depreciation recapture, you will also have a slightly higher rate on that depreciation capture portion of your gain. It's highly likely anyway. So let's say you don't want to pay tax on the gain, but you do want to get rid of this property. There's a couple other methods for deferring the gain. One way is to do a 1031 deferred exchange, which means you're going to buy another rental property to replace this one. If you buy the rental property for the same or more, it's likely you'll defer all the gain. If you buy for less, the value, if you sell for $300,000, buy for $250,000, there's a high likelihood you're going to report part of the gain or all the gain, depending on how far down you buy. So a big confusion with 1031 exchanges, you can't just take the equity from your property and buy another property for cash. It has to do with the loan on this property, the value of this property, and the loan on the new property, and the value on the new property. We'll have another episode just on 1031 exchanges. In any case, you could do an exchange this property for 2 other properties, 3 other properties, or just one. So it could be multiple. And it has to be like kind. So it has to be rental property for rental property. It can be investment property, it could be land. It could be a commercial building, and it could be a residential property. So there's some flexibility. Let's do some air squats. Okay, let's talk about one more opportunity, and that's called an installment sale. So if you don't have a loan in your property, because it gets a little complicated with loans, if you don't have a loan in your property, you can take a note back from the buyer. So if you're selling for $300,000, and you say, I'll take $20,000 down or $30,000 down, and I'll finance the rest. You'll be able to stretch the gain over a long period of time as long as you have the note. The note is accelerated and paid off. You'll owe all the gain then. The good part of this is if you're in a lower bracket, the gain is reported in a lower bracket, and the tax may be very low. The bad part is they could take out the loan, refinance, pay off the loan, and then you've got a problem because you have all the gain then. Usually prepayment penalties are stuck on loans like that to discourage them to pay it off in advance. So we have sell the property, pay the tax. We have do a 1031 exchange, defer the gain into another property, which some later date you may need to pay tax on. Or maybe an installment sale. These are the choices that as we know them right now. On the next couple installments of rental, we'll talk about the 1031 exchange and rental expenses and income and how to report it. Okay, keep working out. Thank you. Have a good day.